Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Today, I'd like to talk about a topic that sits at the very heart of sound SBA lending decisions: the accuracy of financial information in business valuations, especially when a business division is being sold. In SBA 7A lending, the valuation is more than just a number. It's the foundation on which your underwriting, risk assessment, and borrower repayment assumptions are built. And when that valuation rests on questionable or inconsistent financials, the entire deal is at risk. Why does accuracy matter? Valuation professionals rely on financial data to determine a company's value using income, market, and asset approaches. But in a divisional sale, we don't get tidy standalone books. We get carve-outs, sliced, diced, and often prepared by internal bookkeepers, not CPAs. And that's where things can go sideways. Let me share a real-world case we recently encountered. A client was selling a division of a company with financing through an SBA 7A loan. The internal financials for the division painted a rosy picture, but when we compared them to the parent company's tax returns, key numbers didn't match. Officer compensation was wildly inflated. Expense categories were off. And the CPA who did the tax work? They refused to reconcile the books. The lender still wanted to proceed and pressured us to just use the divisional numbers. But as appraisers, we can't ignore red flags. And neither should you. As you know, SBA SOP 50-10-8 requires a formal business valuation if the loan exceeds $250,000 or if there's a close relationship between buyer and seller. That valuation must come from a qualified source, and it must include a conclusion of value, not just a ballpark estimate or calculation. But here's the catch. If the valuation is based on inaccurate or unsupported financials, it's not compliant. And that can put your SBA guarantee in jeopardy. So what should raise your antenna? Here are some of the most common red flags we see in divisional financials. Officer salaries that don't match the tax returns. Shared expenses not properly allocated, think rent, utilities, insurance. Revenue recognition games between divisions and the parent. Missing or omitted overhead expenses. Financials showing dramatically better margins than the parent company. Expenses miscategorized, like personal travel coded as marketing. No reconciliation from the CPA. Frequent revisions to past period results with no documentation. Any of these issues can distort the valuation, and that can lead to loan decisions based on fiction instead of fact. What's at stake? First, a valuation based on unreliable data means the buyer could overpay and struggle to make loan payments. Second, if the SBA audits the file and finds the valuation was based on unverified data, the guarantee could be denied. Third, the appraiser could face liability, but so could the lender if it's shown the issue was known and ignored. Remember, a shaky valuation doesn't just affect the buyer. It affects your credit exposure, your portfolio performance, and your regulatory standing. From the appraiser's side, professional standards are crystal clear. We must exercise due professional care. We must obtain sufficient relevant data to support our conclusion. We must remain objective, even if the client pressures us to just go with it. If reliable financials aren't available, it's not just our right, it's our duty to walk away from the assignment. So, what can lenders do to support cleaner, stronger valuations? Require reconciliation of divisional financials to tax returns, ideally by a CPA. Don't accept unofficial divisional P&Ls without documentation. Encourage borrowers to be transparent and proactive in preparing clean books. Support the appraiser's role in asking tough questions and pushing back on bad data. And finally, don't rush the process. Time pressure is the enemy of quality. A business valuation is only as good as the data behind it. If the foundation is flawed, the entire deal may be built on sand. As SBA lenders, you have a lot riding on that valuation. The appraiser isn't just checking a box. We're your early warning system. If the numbers don't line up, it's not a nuisance. It's a neon sign that says, stop, investigate, and verify. In an environment where risk is real and regulation is strict, the quality of financial information isn't a detail, it's a deal breaker. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.